The National Association of Equipment Leasing Brokers is the only leasing trade association developed by brokers for brokers. NAELB is over 10 years old, has more than 500 members from across the United States and Canada, and is growing rapidly every year. The NAELB is underwriting this tape series for our members as part of our ongoing commitment to excellence in leasing education. There are many compelling reasons for brokers in the leasing business to join NAELB. All members of the association subscribe to a code of ethics and agree in writing to be held accountable to that code. Members have free access to the NAELB attorney to assist in resolution of disputes, review contracts, or ask help with any legal question. We provide our members with dispute history information on funders and other brokers to assist in fraud prevention. NAELB has many funding sources that participate in our educational conferences throughout the year. Those sponsors help reduce the costs of these events to our member brokers. However, those funding source members are not voting members of the NAELB. That privilege is exclusive to broker members. It's the broker members who run this organization. The association website at www.naelb.org continues to grow and provide members with funding sources, information on fraud prevention, leasing education, and direct contact with their NAELB Board of Directors. As the leasing industry continues to change, brokers need to continually educate themselves to stay competitive and improve their bottom line. If you or someone you know would benefit from all the services provided by being a member, contact the NAELB at 800-996-2352. Welcome to the NAELB Education Series presented by Bob Baker. Bob is the Director of Education of the NAELB and was the 33rd person to receive the prestigious designation of Certified Lease Professional, CLP, the hallmark of knowledge and excellence in the equipment leasing industry. Bob was the first recipient of the Bill Granieri Top Gun Memorial Award. Bob brings to this educational series over 30 years' experience in finance and leasing, and is founder and president of the Wildwood Financial Group, the premier leasing education company in America today. Thousands of leasing professionals have attended Bob's seminars, workshops, and presentations through the years. We think you'll find that Bob's relaxed approach to the subject of leasing makes it easy to understand the key concepts that underlie success in our industry.
Hi, I'm Bob Baker, and I am very excited, as well as being honored as the Director of Education of the National Association of Equipment Leasing Brokers, the NAELB, to present to you this video training series. This series is designed for the novice as well as it is for the person that's been in the business for quite a while, and it can be a refresher for folks that have been in the business for a long time. I'm going to be talking to you for several hours on these videotapes to give you some very specific knowledge, but I want to do this in a format that is just like I was sitting talking to you, so it is not designed to have everything exactly as it would be in a CPA's mind. It's not to be exactly as it would be in as an attorney's mind. So these are general, overall things that we're going to try to share with you today. So, you know, as with anything else, you should always get the opinion of your attorney or your CPA for specific legal or accounting issues. We're going to spend some time now visiting about packaging, and basically what we're talking about when we say packaging is to put a transaction together to submit it into a funding source to get the transaction approved, which obviously is an extremely important part of the entire leasing process. I think first, before we start talking about exactly how to put these together, we should go through some primary criteria for our different types of leases. We talked in an earlier series about the types of leasing basically being two different types, one being the mini lease, which are the transactions that we are able to accomplish without any financial disclosure at all, and we talked about how important that the credit application is in that process. And then, of course, we have our package transactions where we're going to get full financial disclosure from the lessee to get that transaction done. Let's kind of go through the mini lease criteria. Now, these criteria that we're going to discuss on the mini lease are going to vary from funding source to funding source, so I'm just going to visit with you about generically pretty much what the most common criteria are, and then you can do a little research internally as far as what your company does if they approve these in-house or if they use outside funding sources to either sell or discount these transactions to. The mini lease, again, being our primary way of doing small ticket leasing, has some criteria to it, and it's primarily 4 criteria that we need to satisfy to have the funding source being warm and fuzzy and approving these transactions. The first criteria is the minimum time in business. Typically, 2 to 3 years is the minimum time that's going to be required to be able to accomplish a transaction without getting into full financial disclosure. Now, there are a couple companies out there that specialize, of course, in doing startup type of companies that are under 2 years in business, but we're talking about the mainstream transactions here, and we need 2 years in business generally as a minimum to be able to accomplish those. And that may change to 3 years or to 5 years depending on the size of the transaction and also the type of equipment and things like that that are involved. For example, some funding sources might go to a threshold of $35,000 with a company 2 years in business, and then anything over that would require 3 years in business. You have some funding sources out there that might say for a restaurant at a certain dollar amount we require 5 years in business. So you need to do research, and this is another very important part of leasing, and we could even put this into the marketing section if we wanted to of this program, because one of the things that is very, very important to do, and again I think this is one of the shortfalls with a lot of folks, you really need to do some internal research on your funding capabilities before you start your marketing. It's just as important to do this as it is to learn about the equipment and the industries that you're going to work in before you start calling on the sales managers to set up these vendor programs, as we discussed in an earlier series. So take the time to know exactly what your funding capabilities are, what your funders' appetites are, and things like that. What you do not want to do is go out and try and find business, and then after you find a transaction, try to find a home for it. You want to do it the other way. You want to be out there working with a rifle, not a shotgun. You want to go out and try to find the type of business that the funding sources that you have like. This time in business requirement is obviously one of those criteria. So criteria number 1 in a mini lease will be a minimum time in business requirement. So we're talking typically here 2 to 3 years. Now requirement number 2 is a satisfactory banking relationship. Now the banking relationship is made up of 3 different components, the satisfactory banking relationship. Number 1, we're going to have a minimum average balance requirement in a depository account. Now, a depository account, by definition, would be any place that the lessee has money deposited, typically in a bank. So for all practical purposes here, we're talking about their checking account. But it also could be CDs or savings accounts. Remember that we talked in a previous section when we were talking about credit philosophy, that we agreed that the primary thing that we have to be sure to fulfill in a credit manager's mind is their ability to make the payment or being able to debt service the lease. In a mini lease, we're a little bit unique in that we know that we have to determine whether or not the lessee can afford the payment, but at the same time in a mini lease we have no financial statements or tax returns, so we don't know if the company's making money or losing money, and we don't know how much cash is available. In that we have to make this determination where we're going to make that determination as to whether or not they have ability is by the average balance in their depository accounts. So, if we have a company, for example, that on an average is bringing in $100,000 a month in revenues, and on an average is putting out $95,000 a month to pay all their expenses, their salaries, and everything else, then there's roughly $5,000 a month left over. Now, if we were to look at their checking account over, say, a 6-month period of time, then we would be looking at an average balance of about $5,000 in that account. Now, the way the banks are going to rate these accounts is in the format of low 4, high 4, low 5, medium 5, high 5, that type of thing. Now, let me explain to you what that means. The number, if we say it's a 4, a 5, or 6, is the number of digits in the amount of money of the average account. If a average balance in an account was, say, $5,000, there are 5 digits, or 4 digits rather, in $5,000. So that account would be rated as a medium 4, because medium is someplace between 1,000 and 9,000, 5,000 would be in the middle. So if we had a balance of $1,000, $2,000, $3,000 as an average, that would be a low 4. If we were to have $50,000 or $60,000 as an average balance, that would be a medium 5 account. If they had $8,000 in the account, that would be a medium 4. If they had $80,000, that would be a medium 5. If they had $100,000 in there as an average balance, that would be a low 6. So that's how those accounts are rated. They're not going to say they have an average balance of $12,850. They're just going to come out and say that they have a low 5 checking in that situation. The bottom line is any funding source is going to require a minimum low 4 checking account. So that would be $1,000 is as low as you could go, because $999, of course, would then be a high 3 account. So most funding sources are going to require a low 4. Some require a moderate 4. Moderate, again, would be medium, so it would be about $5,000. So this is a little bit of a moving target, but between $1,000 and $5,000, somewhere in there is going to be the minimum requirement of an average balance. Now, keep in mind that if you have a company that does not have this minimum depository account, let's say when you do check the checking account that they have a high 3, which is, $700, $800, $900 in there, that's going to blow you out of a mini lease criteria. But again, that doesn't blow your lease and mean you can't do it. That just means that they're not sure that there's enough ability there to make the payment, so now they're going to require some financial disclosure. The second part of our satisfactory banking relationship is that there is no bounce checks or overdrafts. These both indicate a possible cash flow problem and again create a concern about the ability to make the payment, which we know is our most important criteria. I think it is also important for those of you that are novices to define the difference between an overdraft and a bounce check. The primary difference is, in both situations, whether it be an overdraft or a non-sufficient fund situation, a check has been written by the company and there were not enough funds in the bank to cover it. In the situation of a return check, also an NSF, non-sufficient funds, that's the same thing. That means that when that check came in, an officer looked at the account and said, send the check back, we're not going to pay it, there's not enough money. So that check is simply returned back to whoever sent it into the bank. That obviously is a relatively serious situation because that definitely indicates a cash flow problem. An overdraft, for all practical purposes, means that the bank has extended credit to the end user because the check came in and there was not enough money in the account to cover it, but the officer went ahead and said, go ahead and pay the check and we'll overdraw the account and send them a letter or give them a call to tell them that they're overdrafted, but we turned around and covered the check, but please get down here immediately and put some funds in the bank. And then, of course, the bank sends you a nice little note that says, We received this check in for $4,000. You only had $3,800 in the account, but we went ahead and paid it, so please make a deposit immediately, along with $35 as a fee to us for being such a nice guy and covering your check for you. Now, overdrafts are not near as serious, or not as serious, even though they're still a problem. And sometimes if you have an occasional overdraft, maybe one a year or something like that, and the bank will verify that it was a one-time occasion, or if they did have 3 or 4 and the bank says the customer bounced a check on them, that caused their checks to bounce, they immediately came down and resolved the problem. Sometimes you can get around it. But overdrafts and return checks are a serious problem, and in many cases will blow an account out of a mini-lease category. The third part of our satisfactory banking relationship, of course, is that they are paying any loans that they have with that bank as agreed. So again, we want to be sure that we have all of the banking relationships. Now, I want to just give you one scenario as a food for thought when you're going in and getting this information, especially on mini leases. You could have a situation, for example, where a company has a line of credit with the bank of $100,000. They only owe $15,000 on it, and their credit and everything is excellent. That type of company is going to keep a very minimal amount of money in their checking account, because it would be rather foolish to let, $30,000 or $40,000 be sitting there in their checking account when they're over there paying interest on a line of credit. If they have any excess cash, they're going to move that over into their line of credit to reduce their line of credit, because remember, if they need cash for any reason, they can always transfer from the line of credit to their checking account. So one of the things that you always want to be sure that you ask when you're getting your banking information on your credit application is whether or not they have a line of credit. Because if that account checks out with, let's say, a low 4 or a high 3, and you're looking at a $50,000 transaction, it's probably going to be rejected. But if you can show where the company has a $100,000 line of credit and only owes $8,000 or $9,000, your argument is going to be, here, they could have $100,000 in the bank tomorrow with a phone call. So it only shows good business sense to be avoiding paying interest there. But if you don't ask the right questions when you get the credit application, this can make the difference between an approval and a turn down. So criteria number 1 is our time in business. Criteria number 2 is our satisfactory banking relationship. Number 3 is a criteria that is pretty drastic from funding source to funding source. Some are going to require this, most will, but there are some now that are starting to do these transactions without them, which is a relatively new occurrence. But these are the trade references. These are the companies that our lessee is buying goods or services from. Typically, the average funding source wants to see 3 trade references. Now, one of the things that you're going to find pretty much as a common denominator, and even though most funding sources have this in their written credit policy, some of them have it kind of as unwritten law, but I can tell you that you need to be paying special attention to this, because every funding source looks at this, whether or not it's in their credit policy to you or not. And that is that there is a comparable trade out there, or a comparable borrowing. In other words, if this customer is trying to acquire a piece of equipment for $70,000, the funding source wants to see where they have been extended that kind of credit in the past. And here's the primary logic behind that. These transactions that we're looking at under mini leases are being done on an application-only basis without benefit of financial statements and tax returns. If, for example, there's a comparable credit here, let's say in a line of credit where a bank has extended them a line of credit of $100,000, the funding source knows for a fact that that bank had financial statements and tax returns and probably the information on the principal went before they approved that line of credit, because they don't have a mini lease product. Therefore, we know somebody else looked at financial statements on this, which gives us a little bit leg up. So one of the things that you want to look at closely is to see if there's some kind of comparable borrowing out there. Where you can get in trouble is that if you have an excellent credit, been around quite a bit, and when the funding source is doing their investigation, they don't see any bank loans of any size, you know, maybe a few $1,000s, but this is a $70,000 request, and the trade references that they get are something like, well, I pay $40 a month for my cell phone, I have a beeper that's $29.95 a month, and I have a printing company that I spend $100 a month with. There's really nothing there for them to dig their teeth into that shows that they've had these kind of borrowings in the past, and that can put you in a situation where they request financial information. So a lot of times these comparable credits are there, but you have just asked for 3 trade references and you may have missed some comparables. So the other thing to remember is you can always use paid accounts for comparable credit as well. So don't forget to ask for those. So again, this goes back to what we talked about when we were in our credit philosophy section. Look for some comparable credits out there and do a good job of taking the credit application. So now we have 3 criteria covered: time in business, satisfactory banking relationship, and some trade references. Typically they want to see 3 of those, 3 trade references. And then number 4 is satisfactory personal credit on the principals. Now, this is one that is very, very important in a mini lease. The primary credit decision on most of these mini leases is going to be made, the heaviest weight is going to fall on the personal credit of the principals. They're really not looking at the company that hard. There may not, as long as there's not any negatives there, they're going to look very hard because we're going to have a personal guarantee of the lessee, which is primarily the president of the company or the owner or the primary stockholders or whatever of the company are going to have to guarantee each and every one of these leases. Now, are there exceptions to this where you don't have to have a personal guarantee? Yes, there are. And that will vary from funding source to funding source, but it is a very, very small part or a very small number that will be the case. Normally, guarantees are almost always required. For those of you that are new, don't consider that a problem because banks are going to require the personal guarantee of the principals, especially if it's closely held or a smaller company. Remember that this is not going to be a problem for you because everybody else does it. Now, some of the common exceptions is that if the company is D and B rated 3A1 or bigger, 3A would be your companies with $1 million or better in net worth and paying their bills as agreed. Usually that can be waived. And for companies that have been around a long time, with established credit where they have not had to personally guarantee the transaction, a lot of times you can get it waived, but it will be in a very, very small percentage. I would say probably less than 2% of the many leases that you look at will not have to have a personal guarantee. So our primary credit criteria here for a mini lease transaction is number 1, our time in business, number 2, that we have a satisfactory banking relationship, which is made up of a minimum depository account, no bounce checks or overdrafts, paying any loans they have as agreed, our 3 trade references, and someplace in the bank of the trade references a comparable credit, and then of course finally our good personal credit on the principal. Now let's talk a minute about the criteria if we're into a package transaction, which is again a transaction that number 1 does not meet the mini lease criteria, so we need to shore it up and show some financial disclosure to show that that transaction will work. And then of course for our larger transactions that are above your mini lease threshold, and typically these are going to be your transactions that exceed $75,000 to $100,000. First of all, we're going to need 3 years financial statements. If those financial statements are unaudited, then we're going to need the corresponding federal tax returns. Now again, we know that less than 5% of companies have audited financial statements. So I would suggest to you that when you ask a company for their financial information, simply say, I need 3 years financial statements and I need 3 years of the corresponding tax returns. If you say, if unaudited, you're going to create yourself problems, because a tremendous amount of folks out there believe that as long as the CPA prepared their financial statements, that those statements are audited, because they don't really understand the difference between compilation, reviewed, and audited statements that we spoke of earlier. And since we know that less than 5% have audited, just make the assumption they don't. You'll usually find if they have audited financials, they'll jump right back at you and say, well, we have audited financials. Do you still need the tax returns? Why do we need tax returns if the statements are unaudited? Well, it's simply this. If you remember, when we have audited financial statements, we have the accounting firm on the hook legally for the accuracy and validity of these financial statements. And if they're not correct, we can turn around and go after in court the auditing company or CPA, and that gives us a different target. What we're doing by requiring tax returns on the unaudited financials is that the tax returns become our supporting document to the financial statements. And what we are going to do is go in and see if the numbers foot. In other words, we're going to see, do the numbers and the profitability and the numbers that they're showing on the financial statements match what they've shown in their tax returns. Now, the general premise here is that companies can do all kinds of weird and goofy and, you know, if you want to say it in this way, a little bit kinky things with their financial statements. That's one thing. You start messing around with your federal tax returns and getting kinky with those, that's go to jail. So the assumption is that tax returns, you know, our chances of those being bogus are much less than they are with the financial statements. I have seen many sets of financial statements over the years where it showed the company making a pretty good profit, but when we looked at the tax returns, we found that not to be the case at all. I have never seen a tax return showing where a company was making money where they were losing money, because then they would have had to turn around and pay taxes on it. Okay, so first of all, we need 3 years financials, and then we need their tax returns for the same 3 years. Next, we need a current interim financial. Now, we discussed that an interim financial are financial statements that have been prepared since the year end of the company. Now, most funding sources would like to see an interim that is no older than 90 days. I think you will find that to get a leasing company or a funding source to accept an interim financial over 6 months old is going to be next to impossible. If the most current information that you have is December and you're sitting in August, there is an awful lot of information or things that could have changed in 8 months. If you haven't got information that's within that 3 to 6 month time frame, you're dealing with information that is so stale that I don't think you're going to find hardly anybody that's going to play with that type of transaction. So you need an interim financial that hopefully is within the last 90 days, but certainly no older than 6 months. Now, the other real important thing to these financial statements, if you have a company that is closely held, in other words, we have a company that only has 2, 3, 1 stockholder, or it's a sub-S corporation, as we discussed earlier, you're going to have a personal financial statement on the principals and their corresponding tax returns. The primary reason for this, of course, is that in closely held companies, the company could be made into a shell overnight with 1 or 2 stockholders. They could write a couple checks and liquidate the company. So the personal guarantees are very important, because really, even though legally there is, from a credit standpoint and security standpoint, the premise is that the company and the individual are pretty much one and the same. The other side of that spectrum is that if you have a small, closely held company that goes out of business and goes bankrupt, 99% of the time, the owner of the company is going to go bankrupt as well, because they're guaranteed on everything. So everything is commingled and very important. So you're going to need this financial information on the principals, and you're going to need the tax returns on them. Now, let's now that we've gone through the criteria for both the mini lease and for the package transactions, let's start talk a little bit about what we're going to need to do to submit this into the funding sources to get these transactions approved. When we're sending in a package to a funding source, let's talk a little bit about the purpose of sending this in. We want to talk about the elements of the lease package that we're sending through. We want to talk about the detailed questions that lead through the narrative to one of these, because we don't want to write a book, but we do want to tell a story. And when we're doing a larger transaction versus a mini lease, we're going to have to give a little bit of a write-up or narrative, if you will, to the funding source. The best way I can explain this narrative to you is think about if you owned a company and you need to go out and acquire a couple pieces of equipment for $100,000 each to go into your manufacturing floor because your business is picking up and you have all these additional orders. So you're walking into a bank with your financial statements and your tax returns, and now you're going to sit down to the bank and say, Mr. Banker, you know, I've been in business this number of years, here's what's going on, and you're going to start talking to the banker, telling your story. Well, that's what this narrative does. This is us taking the information from the lessee, putting it into a very succinct, comprehensive story, which is our narrative, and submitting that to the funding source so they understand what we're trying to do. And then we're going to support that with our different financial instruments like our tax returns and financial statements and credit bureaus and bank investigations and that kind of thing. And then we're going to come to a conclusion and write up the conclusion to the funding source of exactly what we want to do. Now, in leasing, you're going to find that there are primarily three basic sales that we have to deal with. Number one, we have sold the vendor on putting a program in there to help them increase their sales, and we've talked about this at length in the previous series. Number two, after the vendor sends us a transaction, we have to close this up with the lessee, get the lessee very comfortable with it, go in and turn around and get the transaction, having a proposal issued and getting a check, getting this transaction off the street. So sale one's to the vendor, sales two is to the end user, the lessee, and then sale three. And a lot of folks will tell you, and I totally concur, that this is really the most important of your three, and that's selling this transaction to the credit authority, whether it be an internal credit manager to an external funding source, because if you can't get the transactions approved, all of the work that you've done to turn around and set up the program with the vendor, and all the work you've done to set the thing in motion with the lessee and get control of the transaction, all of that is for naught if you can't get the transaction approved. So again, that is why it is very important that you use a rifle and a shotgun and you're out there trying to get the business that your funding source is going to like in the first place. And number two, it's another reason why you want to control these transactions. And most importantly, this is why it is very important that you understand exactly what the criteria is for your funding sources. And that way we can make sale number three and bring this transaction to conclusion. Okay, we've talked about our three sales to the vendor, the lessee, and the credit authority. So let's kind of give you a financial package checklist, first of all, of the things that you need to be sure you have. It's important that you put these things in a order. They don't necessarily have to be in this order. You can set up your own, but you should probably submit them the same way each time. And remember, again, you want to use the philosophy a little bit with these credit managers. If you put in a nice, neat, concise package, you're going to find that you're going to get answers faster and you're going to get them easier. So number one, we need to, on every transaction, whether it be a mini lease or a package, we need to have a good, complete credit application. Now, if you have a very large transaction with a lot of banks, on the credit application itself where the banks are, it may say, see sheet attached or bank reference sheet attached, and it could be the same thing with the trade references. But all of your pertinent information on the company, the legal name of the company, how long they've been in business, the type of entity they are, how long they've been around, who the principals are, where the equipment's going to be located. All that needs to be complete. So just because you have a big transaction on a big company with a lot of financial data supplied, you still need a good credit application. Next, we need to have those financial statements. They should be in order by year. Then we need to have the corresponding tax returns. We're going to need the interim financials. Then we're going to need the personal financial information on the principals. One of the things that is very, very important that you do in a package, and this may sound like an obvious thing to do, but it's one of the things a lot of folks forget to put into a package, is the equipment justification to the lessee. If they are buying a piece of equipment, you need to tell the funding source why they are buying this piece of equipment. Is this an additional piece of equipment? And if it is, why are they buying an additional piece? Is it because their sales are up, because they need higher production capabilities? If you think about that, that turns around and shows that the company is growing, and there's a good reason for them to buy this equipment, to be adding additional debt. This may turn around and be a piece of equipment that is being replaced. That means it's going to be more efficient, which means their expenses are going to be less. That type of thing. And again, if they were adding additional piece of equipment, maybe it's because they had been outsourcing what this piece of equipment is going to do. And in many cases, this new piece of equipment, they may be costing them nothing, and in fact saving them money, because they're getting in a piece of equipment that may cost them a couple $1,000s a month, but at the same time it's eliminating $5,000 a month in expenses. You need to look at this justification, be sure that it's there, because if you have a CPA, for example, that wants to lease a forklift, you better start asking some questions, because that doesn't make sense. Next, we need a good description of the equipment. Now, in some situations, that's going to be very obvious, but in most cases, it's not. So have good description of the equipment. And remember, one of the things that you want to break out here in this equipment description is soft cost if they're involved, because the funding source is going to ask you that. This is a good place. If you remember, we talked about when we were putting our vendor programs together to get brochures from the vendors. Funding sources and credit managers love color pictures. So, this is where you could also include a brochure on the equipment if it's anything that's unique at all. Again, we want to talk here about exactly what the cost is going to be in total and how much money that we're requesting. We want to give the information on the vendor. Now, we discussed this before, but it certainly justifies talking about this again. Fraud is the largest cause of losses in our industry, and we're going to be covering fraud in a separate section by itself. But part of your credit approval, and remember this because it's important, is not just getting your lessee approved because of all this financial information. You need to have the vendor approved as well. So this is where you would include your vendor profile and the information on your vendor to show that they're not going to have problems after they get this equipment, that there's not a vendor around to take care of it or service it, or that everything on this transaction was done on the up and up. The other thing to be sure to point out is the delivery location, where the equipment is going to be located. Again, this can have very definite effect on what the taxes are. It also tells them where they need to do their UCC filings, in other words, to show that this equipment belongs to them and protect their interest in the ownership of the equipment. We need to let them know what the delivery date is going to be, and we also need to let them know not only the delivery date, but when the acceptance date is going to be. Remember, in most cases, your approvals are only good for 90 days. So if you have a transaction that you're sending in and being approved now, but that equipment's going to be 4 or 5 months before it comes in, you're going to need to make special provisions with your funding sources now when you get that transaction approved. So you may have to do something like a addendum to your proposal or to the lease that has a payment adjustment in it tied to some kind of index, whether it be T-bills, prime rate, or something like that, in case your pricing was to change between the time that you have it approved and when the equipment is accepted. And remember, there may be a major difference here between the date of delivery and the date of acceptance, because in some cases the equipment could be delivered in a couple, 3 weeks, but the installation time, because training and other things may go with it, may be several months before it's actually put in. We need to send a submission sheet. Now, the things we've talked about are the things that we're going to need to address. The first thing that you want to do in a package transaction is put together a submission sheet. This is like the old dragnet thing in Detective Friday or whatever. That's just the facts, ma'am, just the facts. So we want to just very succinctly put on the top of this package a sheet that says, this is today's date, this thing is going to ABC funding source, it is from you, your leasing company, and you would not believe how many times leasing companies, funding sources, receive a package that comes in from, Federal Express or whatever. It gets pulled out by a person there at the funding source, a big rubber band's put around it, and it's set on a credit manager's desk, and the credit manager's looking through this transaction but has no idea who submitted it. They can actually be ready to approve it, and they don't know who to call to approve it. The amount of the lease should be on this cover sheet, who the lessee will be on it, the equipment location, who the guarantors, if any, are, what the equipment is, who the vendor is, the cost breakdown, how many advance rentals or security deposits that we're getting on this transaction, what the purchase options that's been quoted to the lessee is, any additional collateral if we have that, what the anticipated delivery date is, what the anticipated acceptance date is, how long the lease is going to be for. Now, these are things that are just on a front sheet that are given the very simple facts of the transaction. If you think about it with a credit manager, when he's getting ready to look at a package, what's one of the very first things that they want to know? What the equipment cost is. Is this transaction for $100,000? Is it for $2 million? Because they're going to look at it different. So you don't want them to have to start digging into this package to find out this pertinent information of who's it from, how long is it for, how much is it for, what's the equipment. Just put all these in a very simple cover sheet. Bang, 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 and lay out all the facts of the transaction in front of them. So before they even get into the package, the very first sheet tells them exactly what they're about to look at. What you're trying to do is to do the credit manager's job for them. So all they have to do is go in and verify the information that you've given them. Now, there's a few things that are very important on a package transaction to address unless you just have an absolute slam dunk credit, which is not normally the case. One, you want to talk about the background of this company. When they started, where they've gone, why they've been successful. A lot of times, one of the things that can be very important in this particular discussion is to talk about the management and the background of the people that run the company. Next, again, we have the equipment justification, or why the lessee is acquiring this equipment. Now, we spoke about this earlier in a different section, but one of the things that I would suggest you do, very first thing with one of these packages before you go any farther, is to do the cash flow calculation and put that towards the very, very front of your package so that you're starting out in the credit manager's mind that the deal cash flows. Remember that the most important criteria in a credit decision is to show that they have the ability to make the payment. So if you show that there's a positive cash flow from the get-go, you've got a credit manager looking at this transaction in a very positive light from the very beginning. So again, to run down that cash flow calculation for you, we want to take our net profits after taxes off the financial statement, add to that number the depreciation to give us our gross cash flow, subtract from that the current maturities of their long-term debt, figure out what your payments on this lease are going to be, and take 12 of those payments and add it to this, or subtract it from it, and that should tell us if we have adequate cash flow. And then, of course, after we have that cash flow number, we can add or subtract any extraordinary income or expense items. The next thing that we want to do is we want to deal with the balance sheet. Now, we in the accounting or the financial statement section covered those, and we went through everything kind of generically, but I want to let you know a few places that you want to look for on this balance sheet to help shore up a transaction or make it look good to the funding source. One is to take a good look at these accounts receivables. This number should be a relatively large number. We want to see what the accounts receivable are. You want to see what kind of adjustments they may have in there for charge-off. Looking at the previous years, and we talked about trend analysis, and one of the reasons that we need 2 and 3, 4 years financials is because we want to see if they collect the receivables that they have. Also, pay attention to who these receivables are to, because sometimes you can see receivables that may be from an affiliate company, another company that they own, or a receivable from the stockholders or things like that. So you want to find out if these numbers are real, if those numbers are large. One of the things that I will say to you about financials now, a lot of folks are intimidated by these financial statements, is look at the big numbers. If you look at the big numbers, it will all tend to tie together. You know, a $4,000 or $5,000 number on a $2 million company just doesn't make much difference. If the big numbers will make sense, the small ones will fall in line. I know that may sound overly simplified, but trust me, it'll work. Now, you want to take a look at their inventory and see if they're turning their inventory in appropriate periods of time and things like that, to see if their inventory is large or small compared to what it should be. And again, you can go into RMA, Robert Morris and Associates, and look at what the industry standards are. Your property, plant, and equipment, we mentioned this earlier, this can be a large spot to look, very good spot to look for hidden assets of a company. Remember, their plant and equipment were primarily put onto their balance sheet by cost. And so the equipment and the plant and inventory and things like that could be much greater value than what's actually showing on their financial statements. So you want to be sure to take a look at that. Their long-term debt, you want to pay close attention to that and when that's going to be expiring, because that could have a definite effect on cash flow. And then, of course, look at their net worth, which certainly can help, and there's never enough net worth in the mind of a funding source, so you want to take a look at that. Now, we want to look at the income statement. This, remember, shows the productivity of a company and how they're doing. We want to see that these sales numbers hopefully have been increasing on a regular basis. We want to show the cost of goods have been constant or not getting out of line with sales, that their percentages aren't getting out of whack. And this is one of the reasons that we gave you those formulas under financial statements so that you can do gross margin and things like that. Look at the large expenses. See if they're out of whack, see if they're making sense. A lot of times you're going to find out that this equipment request is designed to reduce some of these large expenses. You have to remember, even though this may sound overly simplified, there are two ways that a company can turn around and increase their bottom line. One is to increase revenue, the other one is to reduce expenses, or the combination of the two. In many cases, this equipment is not going in because sales are greater, it's going in to reduce expenses. They're getting upgraded equipment to be more efficient, to save man hours, because you have to remember, with virtually every company, the greatest expense they have is their people cost. And if they can get machinery to do it that's more efficient and automated, then they can turn around and save money. So in a lot of cases, it's not an additional expense that they're bringing on with this equipment. It's reducing expenses that they already have. We want to be sure that we look at these extraordinary income and expense items that may or may not be on their income statement. If we see a number that's way out of whack from what the other 2 years were, why did this particular expense exist, or why did this particular income exist. If we see a big hunk come in on a company that this company's done $500,000 of sales every year, and all of a sudden, boom, they had $1.5 million, and then the next year it went back down to $500,000 or something, or the year that we're looking at it's $1.5 million, we might find out that they got a contract for $1 million with a company, which is great, brought a lot of money in, but it was a one-shot deal. It's not going to be reoccurring. Or it could be that they sold off some equipment or a building or something like that and brought a lot of income in, which makes the numbers look good today, but again, that's a one-time income item. Conversely, it can be the same thing with an expense. We could show numbers that don't look very favorable in a particular year, but they may have lost a lawsuit, they might have gotten hit with a big tax lien, they might have had a large charge-off on a receivable where one of the companies that owed them money went bankrupt or something like that. So pay very close attention to that. We want to look at their net incomes, and again, be sure you look at the dividends and the distribution. It could be because these numbers don't look real favorable. It's because the principals have taken out a tremendous amount of money out of the company. But if we have the personal guarantee of the principals and we're looking at their personal financial statements, then the transaction still may look very substantial and you won't have a problem. Also look at their depreciation to see if those numbers are high or low. This could indicate that they've taken on a lot of equipment, or it could be to show that they're paying off a lot of it, and you can kind of see that from the depreciation. And again, and I cannot emphasize this enough, even though you have to wade through these sometimes, take the time to read the notes that accompany the financial statement, because this is where all your subsequent events and contingent liabilities may be, as well as operating leases, because if there's a problem out there, we need to know it. If there's litigation or something like that, the funding source is going to notice that. Of course, along with our financial information that we're giving them here, we want to be sure that we're giving them good bank references, that we have established all of the banking relationships and our trade references. And then what we want to do in our narrative is we want to give them a summary of the positives and the negatives, and then, make our recommendation. Now, what we want to do in this narrative is summarize all of our key points. We want to address all the basics of the financial package, our financial statements, tax returns, personal financials, and that type of thing. Now, this is another area I want to cover here that is a huge mistake, in my opinion, that a lot of folks make when submitting a transaction. If there are negatives, if there have been problems, or there's problems that exist now with this company, the smartest thing you can do is to point them out in great, big, huge, bold letters and underline them and show them to the funding source, because I'm going to guarantee you this: they will find them. They are trained to look for the negatives. They're going to find them. Do not try to hide them. The best thing to do with the negative is to point them out and say, here's a negative, here's why it happened, here's how it was resolved, here's why it won't happen again. If you can't, justify that negative, and that's a cause for a turn down, you shouldn't even be submitting this transaction in the first place. Don't think that you're going to hide or bury a negative, because it's not going to happen, and all you're going to do is get a bad reputation with that funding source that you do try to hide them. Point out the negatives. Credit people are going to find them. Also, be very positive that you point out the positives. They will miss positives. They're not looking for the positives, they're looking for the negatives. Funding sources tend to go in and look for the reasons that are wrong with the transaction, and in lieu of those, they'll approve it. But they can miss positives, so be sure that you point those out. And then, of course, after you've done that, summarize that transaction and give them your recommendation. The bottom line in this packaging is that you want to do the credit manager's job for them. Put these in a nice, succinct, neat package. I would suggest that in a lot of cases you bind these things up if they're substantial, and if you don't have the equipment and you don't do a lot of these, you can run them down to Kinko or somebody and have them do them. But when you do bind them, pay special attention that you bind them correctly. Number one, do not put them where those seams are closed, where you open it up and the book wants to flip back closed on them. You want to tend to use more like spirals. Be sure that when you're making the copies of all these things, that you leave enough margin on that left-hand side. You're not putting holes in the numbers and things like that. So present that package in a very, very neat and organized manner, because it will tend to get moved to the top of the pile. If you send in a very sloppy package and basically take a brown bag and dump this on the credit manager's desk, he's got to do a lot of rummaging through it and sorting through it and doing all that things that you did, and he'll do that when they get time for it. And when do they have time for it? They don't. So, you know, you'll sit there for a very long time getting your transaction approved. If they know that when your packages come in, they're clean, concise, all the work's been done for them, you've spread all the financials, you have done the tax returns and the cash flows and all that's in front of them, they will tend to go ahead and just grab yours because they can probably make a decision on it in 5 or 10 minutes. Again, the best test for these package transactions before you send them in is to simply say, if this was my $250,000 and I was going to invest into this lease, would I do it? That's the best benchmark that I can give you as far as going through these transactions. So take the time, do your research, get all the information, put it together in a very clean and concise manner. And even though these may be substantial in bulk, the idea here is not to write a book, especially with your narrative. Just be very concise about what you have, point out your negatives, point out your positives, make your recommendation, and take a nice clean package, submit it to the funding source that way, and I think you will find that the approval percentages that you get will be substantially higher since you have put these packages together correctly. Okay, let's summarize a little bit what we need to do when we're trying to present a package transaction to a funding source. One, we need to have a submission sheet on the top that says, this is to such and such a funding source from you, the date today, the amount of the lease, who the lessee is, who the equipment location is going to be, who the guarantor is, the equipment, the vendor. We want to put in there our cost breakdown, our advance rentals, our security deposit, purchase options, any additional collateral if we have them, when we think it'll be delivered and when it'll be accepted. We want to include, along with our front sheet, a little bit about the background of the company. We want to put in there, talk about the management and the folks that are running this operation, and show good equipment justification and why the lessee is acquiring equipment. So we've given them the facts, we've given them the basic background on this thing, and then the next thing, of course, is to be sure that you do the cash flow calculation to show that this thing debt services. Then go through your balance sheet, point out any items there that are good, bad, or that help shore the transaction up. Review the income statement, point out issues there that can help you. Be sure that you have all your banks, all your trade references, that you've got your summary there of your positives and negatives, that you've taken the time, you pointed out the negatives and said, here's why they existed, here's how it was fixed, here's why it won't reoccur. And again, don't forget to point out those positives, because they look for the negatives and can miss positives, and then make your recommendation. Summarize all your key points, point out the positives and negatives, then put the transaction together for them so that you're doing the credit manager's job for them. Present the package in a very neat and organized manner. If you do this each time, as I said, you're going to have a much, much higher closing and a much higher funding to submission rate with your funding sources, which makes them like you. They get used to seeing your packages being done right, and that automatically, just from a psychology standpoint, will help you get more transactions approved.